Good morning and welcome. You're watching Buy Now, Sell Now on ET Now. My name is Alex Matthew and joining me is Cheryl D'Souza to take you through the next 1 hour. Let's quickly take a check on how the markets are faring. It's a steady session somewhat. We have recovered from the low point of the day. Currently the benchmark trading with gains of about 0.6%. And mind you, this is after yesterday's torrid session. And while yesterday you had a significant chunk of the Nifty 50 that was trading in the red, today the opposite is true. The broader markets are also looking reasonably good. The market breadth is looking good. All of the sectoral indices, apart from the Nifty media, are trading in the green at this point. So perhaps that fear was a little overplayed yesterday on account of the restrictions in Maharashtra. But it's interesting, we've got the SEBI chairman Ajay Tagi, who is currently speaking. He's addressing a CII Corporate Governance Summit virtually. Let's listen in to what he has to say.
Transparency and quality in the selection of independent directors and functioning of the corporate boards. Next, I'll come to the issue of gender sensitivity on the boards. As a thumb rule, one would expect women who represent half of the population to be as much represented, if not half, at least somewhat close to that figure on the board of companies. However, as we all know, the actual figures are nowhere close to that. It is not merely a social issue. There are several economic and governance benefits as well of bringing greater gender diversity on the boards. There is evidence-based research across the world which shows that companies having better gender diversity on their board have generally outperformed financially those which did not have such diversity. We in India, similar to certain European countries, adopted the approach of mandatory representation of women on companies' board. The regulatory push by Ministry of Corporate Affairs and SEBI has definitely improved women representation on corporate boards in India. From around 5 to 6% women on board in 2014, the number increased to 12% within just a year in 2015 for top 500 companies. The number has been steadily increasing year on year and stands at around 17% for top 500 companies today. At an overall level, the figure stands at around 19%. In the OECD and developed countries, the figure is more than 25%. While there has been an improvement in gender diversity at the board level, data shows that representation of women in key board committees such as Audit Committee and Nomination and Remuneration Committee remains quite low at around 7%. Clearly, we still have a long way to go. My next item for discussion is separation of roles of chairperson and MD and CEO. The underlying idea for such a separation is not to weaken the position of promoter, but to improve corporate governance. The objective is to provide a better and more balanced governance structure by enabling more effective supervision of the management. Separation of roles would reduce excessive concentration of authority in a single individual. Having the same person as chairman and MD brings in conflict of interest. Globally also, the needle seems to be moving towards the separation of chairman and MD CEO posts. In UK and Australia, the debate has tilted in favor of separating them. Germany and Netherlands have a two-tier board structure separating the roles of board and management. The OECD, the international standard setter for corporate governance, also recommends that the two posts should be separated as a good governance practice. Turning to implementation of this principle in our jurisdiction, listed entities were initially required to separate the roles of chairperson, MD and CEO from 1st April 2020. However, based on industry representations, an additional time period of 2 years was given for compliance. The regulation would now be applicable to top 500 listed entities by market capitalization with effect from 1st April 2022. As at the end of December 2020, only 53% of the top 500 listed companies had complied with this provision. I urge and in fact request the eligible listed entities to be prepared for this change in advance of the deadline. I come to the topic of stewardship code. World over, institutional investors in capital markets are expected to shoulder greater responsibility towards their client and beneficiaries. Meaningful engagement with the investee companies, including the credible monitoring, commonly referred to as stewardship responsibilities, is all the more important in the Indian context, where there are concentrated ownerships and non-institutional investors may lack awareness. The institutional investors can and should act as a counterforce to any unwanted decision being pushed in the board, which may not be in the interest of all stakeholders. Institutional investors need to formulate comprehensive policy on the discharge of their stewardship responsibilities, publicly disclose it, and review the same periodically. In December 2019, SEBI prescribed stewardship code for mutual funds and all categories of AIFs in relation to their investments in listed equities. This code has been implemented from 1st July 2020. In order to further improve transparency, SEBI has recently mandated mutual funds to cast votes compulsorily in case of company resolutions on some specified matters. I would strongly urge the other institutional participants in the corporates, such as banks, insurance companies, and pension funds, to also follow transparent stewardship code so as to be truly accountable to their clients or beneficiaries. Coming to ESG framework, worldwide there is now an increased focus on ESG investing. As per an estimate, total assets in sustainability funds have increased threefold from $550 billion in March 2018 to around $1.6 trillion in December 2020, managed by more than 4,000 ESG-based funds globally. Further, COVID-19 pandemic has also heightened the focus on sustainability-related risks. The November 2020 US Federal Reserve Financial Stability Report acknowledged for the first time the impact of climate risks on financial stability. Companies across the globe are facing pressure from their investors and increasingly from regulators to disclose their ESG-related risks and opportunities. Similar trend is seen domestically also. During 2021, that is last year, ESG-themed NFOs accounted for about 1/10 of the total number of NFOs and 1/8 of the amount mobilized by all of them. As on March 25th this year, the assets under management of domestic mutual fund schemes with ESG theme stood at rupees 10,830 crore, which is 3 times the.
And that was SEBI Chairman Ajay Tyagi addressing at the CII Corporate Governance Summit, saying that important for Chairman, MD and CEO roles to be separate in companies. He's urging all the listed entities to be prepared for change in the board structure. Also saying separate management roles in companies will cut conflict of interest. He also spoke about ESG framework, saying the governance is a key element in that as well. All right, moving on then. Now, while the market was actually focused on cyclicals as well as industrials, it was IT and mid-cap IT companies that have actually outperformed in the last 1 month. Here's ET Now's managing editor, Nikush Dalmia, to decode the outperformance in the IT sector.
Well, last 1 month, US bond yields have gone higher and the P multiples for growth stock in a sense has got stuck. But mid-cap IT has managed to surprise everyone. A catch-up on valuation, or perhaps this is an indication that markets now believe that after the re-rating in large-cap IT stocks, mid-cap IT stocks will also do rather well. Mindtree in last 1 month has given a return of 21%. 21% in 1 month for any stock in any kind of a market is a fantastic return. The valuations is where the change has happened. Market price is a function of EPS into PE. While the EPS spike for FY22 is unlikely to be great, but the market's perception towards some of the mid-cap IT stocks has changed. They're considered to be much more linear, and given the recent strength in the dollar index or weakness in the rupee, some of the mid-cap IT companies have seen a massive expansion in P multiple. Most of the mid-cap IT stocks are trading at P multiples which are higher than the 5-day average. That kind of a gap or that kind of a P multiple expansion is also visible in large cap IT. It all started with large cap IT. Now mid cap IT stocks are also joining the party. That brings me to the most important aspect, earnings season. Next week, or same time next week, we would be taking a deep dive into the earnings season. As always, it will start with IT. What are the broader expectations? Sequentially, which is what you need to look at year on year, don't look at anything because same time last year the COVID factors were at play. So for a change, ignore this. But CLSA believes that we are in for a growth of anywhere between 3.5% to about 4.5% for more optimistic. That's more optimist estimate. However, they feel that TCS once again will really lead the pack with a 4% sequential growth. If there is one thing which has happened is the relevance and importance of Indian IT companies. They've become bigger, they become much more adaptable, their business model is very agile and something which in a sense is now getting very well recognized. But the question is that now that P multiples have expanded, where is going to be the next uptick for IT stocks? I don't think it's going to be on the perception front. It really has to be on the earnings front.
All right, moving on, let's take a look at which are the stocks that find a mention in today's BNSN stock cloud of the day. A couple of stocks that are buzzing. A lot of them have come out with their Q4 operational performance. So first up, Shobha. That particular counter is surging in trade as their Q4 sales have risen nearly 48% on a year-on-year basis to about 1.34 million square feet. The revenue from total sales also has seen a jump of about 54% on a year-on-year basis. Your Morgan Stanley also, that's kept an overweight stance on Shobha Realty, so that Shobha Limited, so that company is surging in trade. Jindal Steel and Power also came out with their performance for the March. They said this March steel sales have surged 61% on a year-on-year basis to a record 5.86 lakh ton. This is driven by robust domestic demand and attractive exports market. You have Tilak Nagar Industries is buzzing. That particular counter is buzzing as they've signed a 10-year agreement with Pernod Ricard to manufacture its products at the company's bottling facility in Maharashtra. They are looking to expand. They said that the cooperation could expand to other states as well. Ircon International, the company's board has approved 1-for-1 bonus share issue. You also have Burger King that is buzzing in trade. ICRA Ratings has upgraded Burger King's long-term as well as short-term credit rating. Also, the upgrade takes into account significant improvement in company's credit metrics is what ICRA is saying. Inox Leisure will be in focus through the course of the day as the board will be meeting today to explore raising funds via a public issue or rights issue or private placement. Bajaj Finance, another counter, they came out with their Q4 operational performance. They've sanctioned 5.5 million new loans in Q4 compared to 6 million loans a year ago. This reflecting that the demand for credit continues to be below the pre-COVID levels. Avenue Supermarts or D-Mart also came out with this Q4 operational performance. Standalone Q4 revenue was higher by about 18% on a year-on-year basis. They've added 13 new stores during the quarter. Also, the sale of stores open for 2 years or more grew by about 6% on a year-on-year basis. Apart from that, you have Saregama that is also buzzing in trade. The company has signed a licensing deal with social video platform Thriller. Also, you have Mahindra Logistics that's also buzzing on back of tie-up with Flipkart for electric vehicles. So these are the stocks that are buzzing in trade today and are part of Stock Cloud for the day. All right, now let's get on board. Then our guests for today, we have Kunal Bothra as well as Rajesh Agarwal joining us. Good morning, gentlemen, and thank you for waiting by. Kunal, I'll come first to you. The market is looking pretty decent today compared to yesterday's downward move. So what are your high risk and low risk ideas for us today?
So good morning, Cheryl. I think, the last few days, one thing is very certain that the index moves are difficult to fathom because last week was a stronger week of recovery. The start of this week, yesterday specifically, was a very strong downtrend on the index, and today you're seeing a recovery mode. So I think becoming more of a stock-specific market, and I believe in that aspect, stock-specific momentum is what one should be looking at. So what I'm suggesting is, I'm suggesting to buy calls, and the idea, as I said, is to try and catch momentum, into individual stocks. So the first stock which I'm selecting and picking up is a buy on Wellcorp, Welspun Corporation. The stock looking extremely, strong. The breakout for Wellcorp is, now gaining a lot of traction. You've seen the stock breaking out of a consolidation pattern as well. Indicators are extremely strong. So when you have a momentum based breakout, and if you have support from a lot of momentum indicators, then we believe that the stock tends to perform very well from a short-term view as well. So a buy on Wellcorp, expecting that the stock would move up higher significantly in the next few trading sessions. Buy with a target of 155. Stop loss could be kept at 138. And the second is about Tata Chemicals, the stock confirming a very strong breakout. I think it's a stock which has moved up into a different tangent altogether from being a stock which was at 500, 500 or 450 start of 2021. The stock has already, been entered into the levels of 800 plus. Now I believe at current levels, it looks ripe for another 40 to 50 rupees on the upside from a trading bet as well. So buy on Tata Chemicals, expecting the momentum to play out for the next few days as well. Targets of 840 at least, and stop loss could be kept at 780 mark.
All right, thanks so much for that, Kunal. Rajesh is joining us as well. Rajesh, good morning to you. And perhaps yesterday's down move, the fear was a little overplayed, wasn't it, because of the restrictions in Maharashtra? But what are your picks for today?
Morning, Alex. You said it right. Yesterday it was a knee-jerk reaction on the restriction imposed on Maharashtra, and people thought that it may blow to a full-fledged lockdown, and we saw the kind of selling. In all this, we have found some mid-cap which are trading at a very attractive valuation, and two of the stocks which I would like to recommend today. First one is Graphite India, with a target of 600 odd rupees in the next 3 to 6 months. It's one of the largest producers of graphite electrodes by capacity. And they have a total capacity of 98,000 tons spread over 4 plants, 3 in India and 1 in Germany. Graphite electrodes, which are used in EAF route of steel production, is in huge demand. Not only the demand has gone up, the realization has gone up. They have a whole host of good clients like SR, Tesco, etc. And the valuations are quite attractive. Hence, we feel that this stock can touch 600 odd rupees in the coming 1 quarter or so. And the other one is Cipla. If you look at Cipla, it's a domestic market leader in respiratory and urology department. 8 medicines are among the top 10 domestic brands. They have free cash flow of around 3,400 crores last year. Numbers were good. Domestic business are doing well. US business is also growing well. They have taken cost control initiatives. And despite all this, the stock has not done anything when you compare to other peer group companies. So we feel that not only the performance, but the valuation gap is also there. Hence, we recommend this with a medium-term target of 900 and a long-term target of 950.
All right, gentlemen, do stay back with us. We've got a lot more to talk to you about. In the meanwhile, let's take a short break. We'll be back on the other side with a lot more, so do stay tuned.
Welcome back. You're watching Buy Now, Sell Now on ET Now, and let's get on board our viewer queries. And we have the first viewer query coming in from Zafar. He's saying that he's bought 6,100 shares of BPCL at 448 rupees per share. He wants to know what's the 6-month perspective of this particular counter. Kunal, I'll come first to you. BPCL, a strategic divestment candidate. The process is ongoing. We've also had the divestment secretary say that we expect this to, the divestment to come through in the next, in the first half of FY 2022. What's the 6-month perspective like? How are the charts looking for BPCL, considering there's a lot of news flow also surrounding this particular counter?
Well, I think that's what makes the, I believe the chart and the probably a forecast of the stock price pattern a bit more trickier, because had it been a very recent a very short-term news flow, then the impact for the stock price could probably have been factored in into the stock price itself. by the market participants. But then because it's a news flow where there is no dedicated timeline and you can't have, you may not have too much of certainty, or there's a lot of uncertainty rather into going into the stock, as well as the theme of divestment around BPCL, which is why I believe making a forecast over here could probably play out both ways. But then when if I assume that the news flow is something which may not dent the stock prices further on the downside, and look at the chart patterns on its pure merit, then I still believe that there is a very strong probability that BPCL could be a stock which can break out soon on the upside. It has a lot of potential. The stock had done extremely well in the last 1 year as well, rising from 250 levels to almost touching the 500 mark as well. Even on the near-term charts, like in the last 5-6 months, it's recovered quite well from those 350, 360 supports to now where it's currently trading at 430. So I believe that the only catch over here, or the caveat, is that there is too much of news flow surrounding BPCL, which is why giving a breakout or a trade over here could probably be a bit tricky. But then if I give merits on chart, then I strongly believe that there's a higher probability that the stock can break past about that 500 levels.
Let's also get in a fundamental view, and I do understand that Zafar is looking for 6 months, Rajesh, but on the fundamentals, would you buy BPCL? And forget about the divestment news and all of that. That will happen in its due course. Just on the fundamentals, would you buy this counter?
Of course I would buy, Alex, because if you look at the fundamentals, they are very strong. They have 4 refineries with a capacity of 38 million tons, 15,000 odd petrol pumps, 6,000 odd LPG distributors, and the demand is increasing. And the added flavor to that is divestment. But what I would suggest is don't confine to your time period of 6 months, because as Kunal said that this time period can extend to 1 year, 18 months down the line. You never know. But the numbers are good. It's a good potential divestment candidate, and fundamentals also justify investment in this. I would say any downside, maybe around 400 odd rupees, would be a good opportunity for new investors to enter. And for this gentleman, I would say stay put in the stock. We have a target of around 580, 600 odd rupees if the divestment takes place in the next 1 year or so.
All right, Kunal, coming to you on this next one, we've got Hussain, who's bought Chemcon specialty at levels of 464. Stock is currently trading below that point at around 412 odd, and he's also bought Granules India at 3,336. And I must tell you that these are significant quantities that he has bought. He's bought 1,500 shares of Chemcon and 2,325 shares of Granules. He's looking for a short-term view. Should he hold on?
For example, on the short-term charts, it doesn't look that attractive, but the only factor of I would say a missing part for Chemcon to really start an uptrend for itself is the lack of volumes. Now, if you see the average volumes for the stock is just about in I would say late thousands. So I think 60,000, 70,000 has been the average volumes for the stock price. Compare this to the volume when the stock was moving up significantly higher from 420 to 540 levels, where the average volume shot up to even 30-40 lakhs a day. So you can imagine that how the volumes or watching the volumes is a very important play for a stock like Chemcon. So I think till the time volumes don't come back again into the stock price, I believe that the stock can remain a bit more sideways. I don't expect any major downtrend, so maybe the investor can hold on for maybe a few more better days where you see volume pickup happening into the stock. Granules, on the other hand, I think even though the stock has gone through a downtrend, but you look at the chunk of volumes which have happened in the last 2 months, specifically in the month of March and the start of April, the volumes have started to increase up higher. The stock still is in a downtrend. So from 450 levels, it's now at, it tested 300 just a few weeks back. But even in this downtrend, you've seen the volume picking up off late, which means that there's a lot of demand and there are a lot of buyers who are coming across on Granules at this 300 mark. Now that generally acts as strong support zones, and it tends to result into a lot of reversals into the stock prices. So with this volume push coming across for Granules, I believe that there's a strong case that if you have a time horizon of say another 3 to 6 months, there is a strong probability that the stock can come back to a 375 to 400 levels as well. So out of the two, I think Granules is a much more better chart. For Chemcon, I think some more confirmation in terms of volume pickup could probably lead to a much more better chart for that stock.
All right, that's Kunal's view coming in on Chemcon as well as Granules India. Rajesh, what's your take on both of these companies? Our viewer has got 1,500 shares of Chemcon Specialty at 464, and Granules he's bought at 336 rupees per share. We've seen specialty chemicals be the talk of the town, like a flavor of the town, and as well as Granules also has seen a lot of momentum coming in. So how does both of these stock look like, and what should our viewer do?
Yeah, I think let's take one by one. Chemcon should be a stock which should be sold on rise, maybe around 450 odd levels. One should try to exit the stock. Despite the fact that this is a specialty chemical company which supplies to pharma and oil field, and some of the products are market leaders. In HMDS, they are the largest in India and the third largest manufacturer in the world. The products have huge demand not only in India but international market also. But despite all this, it's trading at a PE of more than 30, and that limits the upside. So I think 450 would be a good level to exit the stock. And the other one would be, you said Granules. The outlook is robust. August and Metamorphin is doing well. They have 36 NDAs which have been approved. They are shifting their supplier base from China to India to control their costs. And the Q3 numbers were pretty strong. Top line went up by 26%, bottom line went up by 48%. And we believe that this performance is going to continue in the next 2-3 quarters or so. We have a target of around 450 odd levels in this stock, so one can continue to hold Granules. And Chemcon, any upside should be taken as an opportunity to exit.
All right, that's Rajesh's view coming on Granules as well as Chemcon. Let's get on board our next viewer query then, and this viewer query is from Raghunath, who's saying he's bought 1,000 shares of IDFC First Bank at 50 rupees per share. He wants to know whether he should hold or exit this particular counter. Kunal, IDFC First Bank, a stellar run it has had in the last 52 weeks. And also right now, if you see, it is hovering at around 55 rupees per share. What should our viewer do with this current holding? How are the charts looking? Does it make sense to continue to hold on to this counter?
Well, I've been a big advocate of IDFC First Bank right from the time when the stock had broken past about that 35-37 hurdle, which was a huge resistance for the stock, almost a 3-year, 4-year downtrending resistance for IDFC First Bank. And you've seen that change of texture the stock has done post that breakout of this 3740 mark. Now I believe that the stock has channeled itself to a sort of a longer term uptrend. And in this process of a long-term uptrend, you are bound to have those periodic phases of correction. But I think as an ideal strategy, if you can make use of these corrections and try to average out further, bring your cost price a bit more lower. And if you're looking to buy, then I think starting at current levels and then wait for maybe some more level of dips and the market becomes a bit more choppier and volatile, then I believe that the dips could be a bit more intense into these names. So I think as that kind of a strategy, you should be, I would advise that the viewer should be looking at buying IDFC First Bank, or if he's already bought, then holding on to the stock and looking to average on corrections as well. I believe if the trend restarts again for IDFC First Bank and with a time frame of at least 1 year to 1.5 year, I would look at a potential target of 75 to 80 on the stock price.
All right, I want to come to you on this one, Rajesh, because there is a school of thought when it comes to banks that you should pick the leaders, or at least the larger ones, because they have the scale, right, and access to funds. IDFC First has struggled to a certain extent with expanding its CASA book, and that I think has had a bearing on the broad cost of funds for them. Is that something that you would see as a headwind and a reason why you should not pick IDFC First Bank, or do you think that there are several reasons why the investor should in fact hold on to his investment?
You said it right. Unless one has a time horizon of a pretty long period, by pretty long period I mean 2, 3 years, 3 years down the line, then I would go with Kunal's view that it can touch 75, 80 rupees. But in the medium term, I don't think it would go any further from 60, 65 odd levels, despite the fact that Q3 numbers were good. Operating parameters have done well. There was sequential rise in loan growth, but the asset quality front is still sticky. The number of branches are very few at this point of time, and growing the number of branches would be a tough job in the kind of competition we see. So it's better to stick to large cap names like Kotak Mahindra Bank or HDFC Bank rather than going with IDFC Bank for a medium to short term time horizon. But yes, if you have a long term horizon, maybe 2 years, 3 years down the line, it can cross 75, 80 rupees at Kunal said. So it depends on what kind of time horizon you have. But I would go with your view that bigger names like Kotak would be a better choice.
Okay, I do want to mark, in fact, one particular stock that's looking really, really strong in trade today, and that is Laurus Labs. It's up about 5% in trade today on the back of very strong volumes. In fact, the volumes are 4 times higher than its 20-day moving average. The stock is currently trading at an all-time high. It's hit an all-time high, in fact, in today's session, 397.7. From that point, it is dropped just a bit, but it's still looking very strong, up about 5%. It is trading above all of its simple moving averages at this point. And in fact, on the fundamentals as well, remember, in the recent past, the management has actually guided to maintain its margins at higher than 30%. So operationally looking strong as well. And we're talking about Laurus Labs. Let's go to the next question, which in fact is on Laurus Labs. And Rajesh Kumar has got this question on the counter. He's bought at levels of 280, which seems to be looking, Kunal, very, very attractive at this point. In fact, he's gotten at an excellent price point. He's looking for the next 2 to 3 months. He's bought as much as 1,721 shares. So he's making quite the killing on this particular trade. Should he hold on?
Well, congratulations to the viewer for sticking on to the stock, and I think it went into a sort of a tizzy for itself on the upside, a completely different tangent to when the stock had broken past about that 250, 280 hurdle. So I think congratulations to the viewer for holding on to the investments. I think at current levels, I believe that the stock is just ending its consolidation. So it looks fairly attractive. As you rightly pointed out, that today the volumes are much more higher for Laurus Labs, which also indicates that the stock is coming out of a consolidation for itself. And when you see momentum, into these kind of names after a consolidation, it augurs really well for the stock. So I would suggest a hold. Maybe you can book out partial profits over here, but a definite hold for the next 3 to 6 months on the stock would be warranted.
All right, that is Kunal's view on Laurus Labs, saying hold on to this particular counter. And like Kunal also said, congratulations Rajesh for actually holding on to this particular counter for so long. It's at a record high levels, as we mentioned as well. But Rajesh, what is your view on Laurus Labs? How is the outlook looking for this particular counter?
The fact that the stock has done exceedingly well in the last 1 year, if you look from the last March onwards, then the stock has done exceedingly well, rewarded the investors very well. But despite this, we believe that there is a lot of scope on the upside still left. And we have a target of 450 odd rupees in this. The formulation business is doing very good. There are huge opportunities in the US market. They have diversified into ARY area, that's anti-diabetes and cardiology, and that's going to fuel API growth. The return ratios are very healthy, debt equity is very comfortable. The management has aspired that they are going to grow its revenue by more than $1 billion in size in the coming years. So, and on valuation parameters, if you look, FY23 P is just 15. So we feel that there's a lot of upside still left. One can hold on to the stock with a target of 450 in the medium term.
All right, hold on to Laurus Labs is the call coming in from Rajesh as well. All right, on that note, thank you Kunal as well as Rajesh for joining us, giving us your view on the markets, resolving viewer queries and also sharing your top ideas with our viewers. And on that note, we'll slip into a break on this edition of Buy Now, Sell Now, but stay tuned, more on the other side, so don't go anywhere.
Welcome back. You're watching Buy Now, Sell Now. Now, it has been a choppy few days of trade, and like our experts have pointed out, it is a time perhaps to pick on individual stocks. And that is why this is an important segment to watch out for. This is the Chartbusters segment that happened earlier in the day, and this is a conversation with the expert, that is Kunal Bothra, as well as Jay Thakkar. These are the stocks that they spoke about.
Seems to have completed its, triple zigzag correction in a form of an expanded flat pattern, and it has also, now completed a double or a triple bottom pattern on the daily, weekly charts. In fact, this chart is a weekly chart. It seems to have completed a double or a triple bottom on the weekly charts. Most importantly, what you also check is that, it's kind of a fractal now on this chart. That, previously the stock had formed this kind of a, pattern. Prior to the recent formation, there was a breakout, and prior to that, there was a consolidation within which the stock had formed actually this kind of a rectangular pattern. And then, post that, it broke out on the upside. The indicators provided a buy crossover. You can see that the volumes had increased. So volumes were falling quite a lot. And since past 1 year, or maybe 6 quarters, if you see, the volumes have in fact increased. And thereafter the stock rallied. Now the similar kind of a pattern is formed again. However, the magnitude is lower, but it's a fractal, so it's a similar kind of pattern wherein it is offering a very good risk reward as the stock is reversing from the lower end. So I think, on the lower side, one can place a stop loss at 860, and one can target around 1130 to 1490 on the upside on Alembic Pharma. So here you can see the risk reward is 1:5. In fact, we also check the momentum indicators on the weekly charts, and you see that it has reached to the zero reference line. That means the downward cycle of this momentum indicator seems to be reversing now, seems to be completing its downtrend, and from here on is likely to start its uptrend. So from the momentum point of view, from the volume point of view, as well as the chart structure, Alembic Pharma seems to be providing a very good risk reward. One can buy this for a target of 1130 and 1490.
I think interesting charts on Canara Bank because of the way the setup is on the indicator front. So I've mapped up the charts for Canara Bank, and on the top grid, on the upper grid is the stochastic oscillator for the stock, and it has a good hit ratio in terms of whenever the breakouts have happened for stochastics. The stock has also moved up in a very similar kind of a direction. So I've just mapped up a few of the instances in the last 5-6 months for the stock, and on the top grid I've marked up with blue arrows. So whenever there has been a bullish breakout on the stochastic oscillator, where you've seen the red line crossing over the dotted blue line on the oscillator, and the resultant effect on the prices, it's led to a stronger degree of uptrend into the stock prices. So sometimes the uptrend has lasted for at least a 1.5 odd month, and the stock has moved up to almost 20 to 25%. At times the momentum has been very narrow, at least in terms of time frame, but the intensity of pace on the upside is far more higher. So similar move you saw in the start of 2021 as well, where the stock moved up almost 10 to 12% in just a matter of 7 to 8 trading sessions, and we are now at the cusp of a very similar kind of a breakout for Canara Bank. So my sense is that if the Bank Nifty goes through a revival process, and if Canara Bank manages to provide this breakout, I think it could be very, very rhythmic kind of a price action for the stock, and it could probably result into at least a 1 to 2 week upside on the stock. So it's a stock to watch out for, Canara Bank. Stock is priced at 148. If the stochastic oscillator confirms a breakout, then I believe at least a 10% on the upside could be a probable target for the stock price.
All right, and let's talk about some stocks that are making news today. And Jindal Steel and Power is one of such stock. A metal index on the whole has hit a record high level today. Your JSPL, that is at a 52-week high, and they've posted record production and sales. We caught up with MD VR Sharma and tried to understand their capex plans. Listen into what he has to say.
You see, we have reached to a level of 7.5 million ton now. And last year we were at 6.3 million ton last financial year. And last financial year we were at 5.5 million ton. So a journey from 5.5 million ton to 6.3 and then finally 6.3 to 7.5 million ton is a growth of around 18%. And sales growth is about 20%. As far as the room is concerned for the further extension or further increase in production, so without expanding, without putting any capex, we feel that we'll be in a position to deliver about 9 million ton from our plants, and that is the ultimate. This is what I can say today. So we still have a room of 1.5 million ton. Hopefully, the current financial year will touch 9 million ton. If you see our production in the last quarter, it is 2.07 million ton. If you multiply it by 4 in 4 quarters, then we are already at a level of about 8.4, 8.35 to 8.4 million ton. So with the little changes in the system, little changes in the product mix, little change in the overall strategy, we will be in a position to reach to 9 million ton. This is what we are expecting in the year 21-22.
Let's stick with the overarching conversation on steel then, because there is a lot of interest in the dynamics at play right now. And in fact, Kenneth Andrade, who is the founder and CIO of Old Bridge Capital Management, weighs in on this conversation about the dynamics at play. How does the demand and supply factors play out, and how does that impact the profitability of steel as a commodity? Listen in.
So I look at it a little differently, Nikunj. So there is always a pool of profitability in that value chain. For a very large part of the last decade, that belonged to all the users of the metal, users of the commodity. Okay, what you're seeing out here is just a transfer of that profitability from one end to the other extreme. So here, when you look at the aggregate profitability, that may not change, and it won't. It will just shift from one company to the other. So it just moves up and down the value chain, which I think it's over a period of time, supply has gotten constrained in steel and demand has been at a steady clip. So I wouldn't say that margins will come back for the automotive companies, but definitely that shift in profitability is moved towards the commodity business. And in all likelihood, it will stay for some time till new capacities come up, not just in India but globally.
All right, let's move on and let's talk about Shobha Limited. That particular counter is surging in trade, 7% uptick coming in on Shobha. This is on back of their Q4 operational update. They've said that it was the best Q4 in history for the company. Sales volumes, total sales value, as well as price realization are higher on a year-on-year basis. They're saying average cost of borrowing has also dropped in this quarter. So Citi has also maintained a buy stance on Shobha. They have a target of 520 rupees per share. They're saying strong realization, robust new launches to drive the growth for Shobha. Citi is also saying the average interest cost has reduced further. They have a buy call on Shobha led by quality, quality of operations. So Shobha definitely shining in today's trading session. 7% uptick coming in on that particular counter on back of their Q4 operational performance. So Shobha is one counter that to watch out for through the course of the day. Also moving on, we caught up with Union Bank MD and CEO Raj Kiran Rai and tried to understand whether the credit cost will normalize in FY22. Listen in to what he had to say.
The credit cost for the bank full year can be anything between 2 to 3% for the system.
How much do you feel the second wave is going to have an impact when it comes to MSMEs, some other industries with lockdowns imposed on certain states?
Now the lockdowns are very localized only in certain pockets. So we need to see how it plays out because it's the initial phase of the second wave. So now we are having much better management capabilities for handling COVID. with vaccine availability and better treatment lines, hopefully it can be controlled better. So as long as it is localized in few pockets, we don't see much damage. So, but we need to see how the things will evolve. So if it continues for a longer period, yes, there can be impact. But then if it is only for a month, I think we'll come back quickly. We are sitting on a gross NPA of almost 90,000 crores and a return off book of almost 30-40% of that. So it's a quite big number, and the number of accounts involved are also quite huge. So what we did is last year we created a SAMV vertical, what we call the stress and asset management vertical, with the exclusive branches handling only the stressed assets. Now, when we are doing it, actually, we realized that we need a strong digital platform to handle it, because there are litigations going on at the various DRTs, there are court cases going on, there are surface eye notices, lakhs of notices being issued. So we felt the necessity that we need to bring it in one common platform and link it together so that we have a better MIS and we monitor it more aggressively, because we need to recover, because we have made almost 86% provisions on all these accounts. So it's the time to write back, because there was a cycle where there was aggressive provisioning. Now the cycle has started where we need to see the provision write backs. That can happen only with aggressive recovery. So
All right, so we're leading into the outcome of the two-day meeting of the Monetary Policy Committee. That, of course, is coming out tomorrow. And remember, this is the first Monetary Policy Committee meeting of the new financial year. A lot is at stake. The expectation is that there will be a status quo on rates, but that the MPC will remain accommodative. Any commentary, of course, on inflation will be very keenly watched, rather, because though you've had the last 3 months within the RBI's comfort zone, it has trended slightly higher and core inflation has actually remained stubbornly high. Of course, here's Dr. Aurodeep Nandi, who is India economist and vice president at Nomura, who's speaking about the Monetary Policy Committee's decision, and he's essentially saying that Nomura says that the wait and watch mode is the inevitable for RBI at this juncture, and he also stressed that the policy reversal and rate hike regime is still a few quarters away. Here's an excerpt of that conversation.
Wait and watch mode is kind of inevitable in this policy. RBI has a bit of a dilemma in terms of, how do you leave a house party without offending the host? So you want to normalize, right? Because indeed growth is picking up. Indeed, you've got pretty strong inflationary pressures there. Core inflation is quite elevated. You have cost push pressures that are slowly translating into more generalized pressures. You've got services and core goods inflation, those pressures inherent in the system. So the key question, the way to think about this is, will the second wave materially impact RBI's growth outlook? And while it would increase uncertainty, the answer is probably not. RBI has a very conservative growth estimate for FY22 at roughly 10.5%. We don't see that being impacted much by the second wave that comes in. So at this point, I think wait and watch is sort of the best alternative for the RBI, both on rates, both on stance. But what's going to be really important for the April policy is what revision they do to the forward guidance. See, for so long, they had essentially said that we are going to stay accommodative till the next financial year. Well, that condition kind of gets satisfied in April. So the question is, what next? So they may want to give a time-based guidance. So essentially saying that, okay, I'm going to keep accommodative stance, but for the next couple of quarters. While that gives a very clear indication to markets, it also binds the RBI in some form of corner. Or they could give, which we think is more likely, a kind of state-based guidance that says that, all right, as long as...
All right, and that was Dr. Aurodeep Nandi of Nomura giving his take on what he expects from the MPC meet outcome. Remember, tomorrow is when the RBI governor will be spelling out the monetary policy statement at 10 a.m. To find all the comprehensive coverage on the RBI MPC meet only on ET Now. All right, moving on then, let's find out who are the quiz champions for today. And on the BNSN quiz, we asked you today which of the sectoral indices gave the best return over the past 5 years, and the options were Nifty Pharma, Nifty IT, Nifty Bank and Nifty Metal, and the right answer is a Nifty IT, and that is the best sectoral, that's the top sectoral indices that's given the best return over the past 5 years. So let's take a look at who are the BNSN quiz champions. You have Sagar Tandon, Gaurav Sharma as well as DC, who are the winners of the BNSN quiz.
Well, Cheryl, it has been an outperformer, gains of about 135% for the IT index. On that note, we'll end this edition of Buy Now, Sell Now. Thanks so much for tuning in. Up next is Markets at Noon, so do stay tuned.